Chris here. It is Wealth Wednesday, or maybe I should say lack of Wealth Wednesday, but my intention here is to give you a little bit of perspective and a little bit of insight on how these are the opportunities that allow you to beat the market. So, first couple things, just to make sure we get this out of the way. This is a LTS. We'll call that a long-term strategy. This is not for trading. This is for long-term investing. 3-5 years or more. And it also assumes quality index funds. We'll call that QIF. Funds like the S&P 500 that we know will always return to new all-time highs. If we don't, we have a lot bigger issues than just the stock market going down. And so, the stock market's going down right now, and I bought a bunch of stocks last week. I bought a bunch of stocks yesterday. I'll probably buy some more today. And I'm holding on to some in case the market goes down more, because there's always two giant questions when it comes to a dip. Is how deep is the dip? We don't know that. And how long is the dip? Those are two unknown variables. And when you got tariffs on, tariffs off, tariffs on, tariffs off, there's no way to predict what is going to happen. So you give yourself the highest probability of getting the maximum return out of the market by buying your way down. So I mentioned I bought last week. So let's say I bought right here. I don't know exactly, but I bought some last week. Market went down. So I bought again right here. Now, will the market keep going down? We don't know. But all the purchases that I made on the drawdown are going to be worth more when the market returns back to its new all-time high. The market will do this. We just don't know if it's 3 weeks, 3 months, a year, 2 years. That's what we don't know. But this is how you beat the market. Couple little nuggets just for some perspective. One, there is on average a 10% drawdown once a year. We haven't had one in a little while, so we were due for a 10% drawdown. Could it be more? Does the S&P 500 go down 20% plus? Absolutely it does. So that could happen, and that's part of being an investor. You could, of course, put all your money into bonds, but if you did that, you'd be missing out on the opportunity for equity-based returns. S&P 500 averages 10 to 12% over the last 25 years. Also, 8% drawdowns. We've had 6 of those just since 2022. So while technically we hit a 10% drawdown just for like a smidge of time the other day, really we're kind of more in that 8% drawdown category on this most recent dip. So I know it hurts, I know it's painful, and it takes some cojones to buy on the dip, but this is where great investors make their money. Thanks for watching. Happy Wednesday.